You ever feel like you're just caught on that hamster wheel, working crazy hours, trying to find that work-life balance everyone talks about, but mostly just feeling stuck?
Oh, absolutely. It's that modern grind, isn't it?
Yeah, and then that little voice pops up like, okay, seriously? Where am I going to be in 10 years if I keep this up? It's a really common feeling, I think.
It totally is that constant push, but also this, you know, deeper desire for
Mm,
more,
right.
more freedom, more choice, just more enjoyment out of life.
Exactly. And that's really what we're diving into today. We've been digging deep into Mike Desormeaux's book, Wealth Won't Wait, looking at a whole stack of his insights.
Right. We're going to unpack his perspective on hitting financial freedom, specifically using real estate investing as the vehicle,
Our goal here is to pull out the really key stuff, maybe bust a few myths along the way.
and give you a kind of shortcut to understanding how real estate can actually be a path to more freedom, more options, without getting totally bogged down in like complicated jargon.
We'll get into some surprising facts and really practical strategies too.
Yeah, should be good.
Okay, so let's dig in. Mike Desormeaux's own background is, well, it's pretty unique and really sets the stage for his whole philosophy. He grew up in Toronto's West End.
Yeah, right near the old Canada Packers slaughterhouses.
Yeah.
It's a rough environment, you know? He talks about seeing dang fights, police actually shooting escaped cows in the street. Intense stuff.
Wow. Not your typical suburban upbringing.
Not at all, but what's interesting is how he frames it. He says that's where he got his street smarts, real resilience.
Mm,
And his parents, even though they didn't really push like formal university education, they drilled in these core values. Work hard, be kind, don't complain.
and he credits those values, more than a degree, for his success.
Yeah, absolutely. He says they were foundational, kindness and hard work.
Then comes this big shift for him, right, around age 30.
Exactly. He goes from basically zero investments,
Nothing.
pretty much nothing, to owning multiple rental properties within just a few years.
Yeah.
He saw this pattern, this common denominator, he calls it.
Which was,
Wealthy people he knew either owned a really successful business or they owned a lot of real estate. And often, the business owners also had major real estate holdings.
so he saw that connection.
He saw it and he just decided, okay, that's the path, and he went for it.
So given all that, why is he so passionate about real estate investing? He's pretty critical of the typical 9-to-5 grind.
He really is. He uses phrases like prison sentence for how it can feel. People are just burning out, right? Working insane hours
10, 12, 14-hour days, yeah.
and still feeling like they're just treading water financially.
It brings up that point about how fragile a single income can be, doesn't it?
Definitely. He points straight at the COVID pandemic. That was a huge wake-up call for so many people, showing how quickly that job security can just vanish.
Yeah.
His argument is basically, look, now more than ever, you need cash flow, and you need solid assets because nobody's going to look out for your family's future better than you can.
That's a strong message. And he's not exactly bullish on traditional investments like mutual funds or stocks for building wealth, is he?
No, he's pretty skeptical. He kind of feels like you're up against these super smart traders' algorithms.
Hmm.
It's almost like gambling in his view for the average person trying to get rich that way.
Mm-hmm.
So connecting that back, he believes your real safety net is cash flow from properties, and the actual physical asset, the real estate itself.
Especially when governments are doing things like lowering interest rates and printing money.
Exactly. He talks about how that devalues currency, all that stimulus money, the trillions flushed into the system. He calls it a wealth transfer.
A wealth transfer. How so?
Well, as cash becomes worth less, people holding assets that appreciate, like real estate, especially in high-demand areas, their purchasing power kind of keeps pace or even grows.
While people just holding cash or assets that aren't keeping up.
They fall behind, their money just doesn't buy as much over time. You really see that impact in places like Southern Ontario.
Okay, let's get into the numbers he uses, because they're pretty stark. He compares investing $50,000.
Right. So $50 in a stock or mutual fund, let's say you get a great return, 5% compounded over 10 years. Your profit is about $31,444.
Okay, decent.
Decent, yeah. But now take that same $50,000, use it as a down payment on a $500,000 rental property.
Right.
If that property also appreciates at just 5% a year, compounded for 10 years, it's worth over $814,000.
Wow.
But the key thing here, the absolute game changer, is leverage. That $50 isn't just growing by itself, it's controlling a $500,000 asset.
Which you just don't get with stocks in the same way.
Exactly. That levered is what magnifies your returns. So your net gain isn't $31K, it's $314,447 on that initial $50K.
That's a huge difference. It really shows how your money can work harder.
Massively harder. And he pushes it even further. He says, okay, what if property prices went completely flat for 25 years?
Which he points out has literally never happened in our lifetime.
Right. But even if it did, just the rental income paying down the mortgage over those 25 years means you'd eventually own that $500,000 property outright.
So the mortgage paydown alone gives you a $500,000 gain on your $50K investment, even with zero appreciation.
Exactly. It's a powerful concept.
And then he contrasts all this with the student debt situation. He calls it a love-hate relationship with higher education.
Yeah, he acknowledges it gives maybe a slight edge, but he hammers the cost increase. Tuition is up, 225% since the mid-90s?
From like $2,000 a year to over $6,500 by 2020. That's crazy.
And the debt that comes with it, people leaving school $30,000, $50,000, even $150,000 in the hole. Plus interest, which can be huge over time.
And his point is, it's kind of absurdly easy for a teenager to get a massive student loan.
Right, like $150K, no problem. But try getting a mortgage down payment for an asset that could actually build wealth much, much harder. It does make you think about priorities, doesn't it?
It really does. Okay, so if this is the path, how do you actually do it? How do you build a strategy? He's clear it's not magic, right?
Definitely not. No super easy shortcut. He says you got to roll up your sleeves. Mindset is huge.
And step one is?
Defining your goals, really clearly. What do you want short term? What's the long-term dream?
Could be anything, right? Quitting the 9 to 5, buying a cottage, helping your kids with a down payment, renovating your own place, whatever it is, having that clarity drives your decisions.
Makes sense. And what about the time involved? Because people are busy.
Yeah, he addresses that. You can be super hands-on, finding deals, managing tenants yourself, or you can go for what he calls a 100% turnkey solution. Basically, you hire a team, they find the property, vet tenants, handle all the management.
So there are options even if you have, zero time.
Exactly. It comes down to your preference and situation.
Now, location. He talks specifically about Southern Ontario having unique factors.
Yeah, this is really interesting. He points to Lake Ontario on one side and the green belt that protected land on the other.
So it's geographically constrained. Right. He calls it like a little island. There's just not that much land available for new houses, especially single-family homes.
Which naturally pushes up prices over time because supply is limited.
Precisely. It creates this upward pressure on appreciation.
He also talks about a metric, the price-to-rent ratio.
Yes, super useful. It's basically the property's price divided by the total rent you'd get in a year. It helps you gauge the potential cash flow versus how much you paid.
And his point is that cities outside Toronto often have a better ratio.
Often, yeah. Like a $1.2 million house in Toronto might rent for $2,800 a month. But a similar house in, say, Hamilton or Kitchener or St. Catharines might cost only $500,000 or $600,000.
So way less upfront.
Way less, but might still rent for $2,300 or $2,400 a month.
So your return on the money you actually invested is much higher, even if the rent isn't dramatically different.
Exactly. Even though the tenants might have similar jobs or incomes, it shows why those surrounding cities can be really attractive investment spots for ROI.
Got it. And he has a really strong warning about relying only on appreciation, doesn't he?
Huge warning. He stresses, prioritize positive cash flow. Always. That monthly income is what lets you weather any storm, any market dips. Don't buy hoping only for the price to go up.
Okay, that's crucial. Let's break down the different types of properties he discusses. First up, single-family homes. The easy entry.
Yeah, that's how he frames them. Often easier to buy, easier to finance, easier to manage.
Why easier to manage?
Well, you typically have stable tenants, often 2 incomes in the household. They tend to stay longer.
Less turnover.
Right. And often, tenants pay their own utilities, which cuts down your expenses. Plus, historically, single-family homes see good, steady appreciation.
Makes sense. Then there are second suite properties.
Yeah.
This is about boosting cash flow, right?
Massively boosting cash flow. A second suite is just, a separate apartment within the house, usually a basement apartment with its own kitchen, bathroom, entrance.
Okay.
And the impact on income can be dramatic. He gives an example. A house renting for $1,900 a month as a single unit.
Yeah.
Convert it to have a legal second suite, and suddenly it's bringing in $3,325 a month from the two units combined.
Wow, that's almost double the income from the same property.
Exactly. It's a powerful strategy.
Are there specific types of houses best for this?
He really likes bungalows built between, say, 1960 and 1980, often over 1,000 square feet on the main floor.
Why those?
They often have the right layout, maybe already have a separate side entrance, which is a huge plus. Just lends itself well to conversion.
What's the renovation process like? Is it complex, expensive?
It can be. He mentions a cost example around $150,000 for a full legal conversion, and you absolutely need the right people involved.
Like who?
BCIN certified inspectors, that's the building code identification number, means they're provincially certified to make sure everything's up to code, safe, legal, super important.
Okay.
And experienced contractors who know the specific city bylaws. They vary a lot. Hamilton might have different minimum square footage rules than St. Catharines, for example.
Right, got to know the local rules.
Right. Absolutely. And he has this killer tip for saving time.
Yeah.
Apply for your building permits before you even officially own the property, while it's closing.
So the paperwork is processing.
Right. So that ideally, the day you get the keys, the permits are approved, and your contractor can start work immediately. Saves weeks or even months of waiting.
That's smart. Okay,
Right.
Next up, student rentals. The main draw here is high cash flow.
Definitely. It's all about renting by the room to maximize the monthly income.
And he mentions an interesting advantage. Parents pay the rent.
Yeah, that's a big one. Often you have the students signing the lease, but the parents are guarantors or paying directly. So you have multiple parties responsible for the rent, which adds security.
Makes sense. So location is obviously key here, near universities, colleges.
Absolutely critical. Places near Brock, Western, McMaster, Waterloo, Guelph. Student demand in those areas has just exploded.
And the numbers reflect that demand.
Big time. He shows how a standard house that might rent to a family for, say, $1,900, $2,000 a month,
Yep.
if you set it up as a 6-bedroom student rental, it could bring in $3,600 a month.
Just by changing how you use it and maybe adding a couple of bedrooms.
Exactly. It's a significant income boost. And he throws in practical tips, like putting 2 fridges in the kitchen. Students always need more fridge space, and furnishing the common areas makes it easier for them.
Okay, now, flipping. Everyone sees the TV shows. Looks glamorous, fast money.
Yeah, the glamour factor is high, but he's pretty clear, not my favorite way to invest.
Why not?
He sees it more like getting a paycheck. The money stops when you sell the property. It's not ongoing passive income like a rental.
And the risks are higher.
Much higher, he argues. Unexpected renovation costs popping up, legal fees, real estate commissions eating into profit.
And the contractor issue seems big for flips.
Huge. Unreliable contractors demanding big deposits then disappearing or just dragging the job out forever, killing your timeline and budget. It's a major pitfall.
He also warns against relying just on the market going up,
Mhm.
right? Like in that 2014, 2016 period.
Oh yeah, he calls that the most dangerous way to get into investing. People were buying properties, doing basically nothing, and selling a few months later for $80,000 profit just because the market was skyrocketing.
Pure speculation.
Pure speculation. That's not a sustainable strategy. It's gambling on the market.
So what's a better strategy for building a portfolio over time? He
Yeah.
mentions BRRR.
Yes. BRRR. Buy, renovate, rent, refinance, repeat.
Okay, break that down.
You buy a property, usually one that needs work, below market value. You renovate it, adding value. Then you rent it out to a good tenant because it's now worth more. You refinance it, pulling out your initial investment and maybe some profit.
So you get your original capital back out.
Exactly. Sometimes you can literally own this property for zero out of pocket on paper after the refinance. Then you repeat the process with the capital you pulled out.
So that's how you build a portfolio without saving up a new down payment each time.
Precisely. It's a powerful engine for growth.
Got it. And lastly, condos. That's
Ooh.
the take there.
Condos are becoming, as he puts it, the new starter home in many areas, especially with affordability issues and cities pushing for more density.
They come with maintenance fees, though.
Right. Monthly fees that cover things like building upkeep, maybe a concierge, gym, pool, that kind of stuff.
What are the risks with condos?
He repeats the warning about buying pre-construction, purely hoping the price will jump by the time it's built. That's speculation again.
Okay. And for resale condos.
The absolute key is the status certificate. You must get this document and have your lawyer review it thoroughly before finalizing a purchase.
Why is it so important?
It's like a financial and legal health checkup for the condo building and corporation. It can reveal massive potential problems.
Such as?
Like, maybe the condo board is planning a huge special assessment, a big extra fee to replace all the windows or fix the roof, and you'd suddenly be on the hook for thousands. Or maybe there's a lawsuit against the corporation. Stuff that could seriously impact your investment or cost you a fortune.
Okay, definitely need a lawyer to check that. So, with all these property types, how do you actually tell a good investment from a bad one? He has a grading system.
Yeah, A through F. Simple but effective. And his core philosophy here is critical. It's better to miss a good one than buy a bad one.
Don't rush into a mistake.
Exactly. Protect your capital.
So what makes a property an A, B, C, or F?
He looks at a bunch of factors. Location, obviously, proximity to good schools, transit, shopping, the condition of the major systems, roof, furnace, electrical, plumbing, the layout of the house. Even things like, is there a really junky property next door that will make it hard to rent or sell?
Right, the junkyard neighbor factor.
It matters. An A-grade property, he says, is the ideal find. Hard to get, but they rent fast, re-rent fast, and sell fast. Demand always outstrips supply.
They just perform well consistently.
Exactly. They appreciate well, attract good tenants easily.
And the bad ones, C, D, F grades.
Those are the ones to run from. C or D might need huge, risky renovations where costs could easily balloon.
Money pits in the making.
Potentially. And D or F grades are often true money pits. Fundamental issues. Bad foundation, widespread asbestos or mold, weird smells you can't get rid of.
Stuff where there's basically nothing worth saving.
Pretty much. He says there is literally nothing to salvage except for the structure. His personal rule is straightforward. If I wouldn't personally buy it, I wouldn't recommend that you purchase it either.
Good rule to live by.
Oh!
Okay, let's talk funding. Getting the actual money. It's not just about going to your main bank, is it?
No, there's a whole range of options. You have your A lenders, the big banks, then B lenders who might be more flexible if you don't perfectly fit the bank's strict boxes. Credit unions are another option. Private lenders, individuals or companies lending money, often at higher rates but maybe faster or with different terms. And joint venture partner.
And tapping into money you already have in a property.
Yeah, that's huge.
Yeah.
Using a HLOC home equity line of credit or refinancing your existing home or another rental property are really common ways to get down payment money.
He says you can sometimes do it with zero to little cash out of pocket.
Exactly, by leveraging the equity you've already built up.
And those joint ventures, or JVs, who are they good for?
They can be great for busy professionals, maybe retirees, people who have capital, but not the time or inclination to do the legwork.
So one partner brings the money and qualifies for the mortgage.
Right, the equity partner. And the other partner might find the deal, manage the renovation, handle the tenants, the working partner. They typically split the returns 50-50.
Interesting structure. Now, choosing the right lender seems critical, not just any lender.
Absolutely vital. And it's not just about chasing the absolute lowest interest rate for one mortgage.
What's more important?
The key question is, can this lender help you get multiple mortgages over time as you grow your portfolio? Do they understand investment property financing?
Because some lenders have caps or tighter rules for investors.
Exactly. Choosing the wrong lender, one who isn't investor-friendly, can literally stop your portfolio growth cold. Or it could cost you tens of thousands of dollars in higher interest rate payments down the line because you couldn't structure things optimally.
So finding an investor-focused mortgage broker or lender is key.
Crucial part of your team.
Okay, so you're funded, you're finding properties. What are the biggest mistakes people make that Desormeaux warns against? He lists 5 big ones. First, trying to time the market.
Yeah, number 1, no one has a crystal ball, he says. Don't try to predict the absolute bottom or top.
So what should you do instead?
Focus on buying good quality income-producing properties, especially starter homes in that, say, $400K, $500K range in solid areas, maybe just outside the hottest core markets.
Why those specifically?
Because those types of properties tend to be more resilient. He points out that even in the 2008 crash and the 2017 dip, when luxury stuff fell 20%, those affordable starter homes held their value much better. They let you ride out any downward pressure.
Good advice. Mistake number 2. Losing a good deal over something small. He tells a story about a fish.
Yeah, the wood plaque-mounted fish story. It's memorable. An investor almost walked away from a great deal because the seller was taking this decorative fish that wasn't technically included.
Seriously, over a fish plaque.
Seriously. His point is, don't let your ego or haggling over a few $1,000s derail a deal that fits your long-term strategy. Sometimes we just have to pay what we need to pay.
Because the long-term gains will dwarf that small saving.
Exactly. The appreciation, the mortgage paydown, the cash flow over years, that's potentially hundreds of thousands. Don't lose that over $5K or $10 or a fish.
Right. Okay, mistake 3. Getting burned on a renovation. This feels like a big fear for many.
It is, and rightly so. Bad contractors can sink you.
So how do you avoid it?
Get referrals from people you trust, ideally within your investment network. Don't just hire someone from an online ad.
And get detailed quotes.
Absolutely critical. Itemized lists of materials, labor costs, clear start and finish dates, everything included. No vague estimates.
Avoid big upfront deposits, too.
Yes, especially with someone new. Get everything in writing. He tells a story about an electrician trying to add surprise charges for travel time stuff, not in the quote. Written agreements prevent that.
Makes sense. Find someone reputable, not just cheap.
Exactly. Paying a bit more for reliability saves money and headaches later.
Okay, mistake 4. The dreaded bad tenant. How common is it, and how do you handle it?
He actually downplays the frequency, which is reassuring. Says with proper screening, it's rare. He personally only had it happen twice in 20 years, across thousands of properties managed or owned.
So screening is paramount.
Totally. But if it does happen, he demystifies the Ontario eviction process. There's a formal procedure, N4 notice for non-payment, applying to the Landlord and Tenant Board, LTB.
The LTV.
Yeah, it's the formal legal process.
Yeah.
Then mediation, potentially an order, and if needed, involving the sheriff. Knowing the steps makes it less scary.
So, back to screening. What does good screening look like?
Collect detailed applications. Don't let them take it home to fill out. Do it there. Verify their income thoroughly. Aim for income at least 3x the rent. Get pay stubs, bank statements, tax returns if they're self-employed.
Credit checks, references?
Definitely run credit checks. And call previous landlords, but be a bit skeptical. Sometimes landlords just want a bad tenant gone. Ask specific questions.
And keep the bigger picture in mind.
Yes. Even if a bad tenant leaves and it costs you, say, $8,000 to fix things up and cover lost rent, compare that to maybe $100,000 in mortgage paydown and hundreds of thousands in appreciation over 5 or 10 years. It's usually a relatively small cost in the grand scheme of things.
That's a good perspective. Okay, the 5th and final mistake. Not having a strong network. He calls this the single best investment.
He really emphasizes this. Your network, your team, your contacts is invaluable.
He uses a furnace story to illustrate it.
Yeah, furnace breaks down at 10 p.m. on a Friday, coldest night of the year. Nightmare scenario, right?
Totally.
Because he had a strong network. One call to his trusted heating guy, problem solved immediately. Without that network. He says it would have been countless hours of calls, research, money, pain, and sleepless nights.
Trying to find someone reliable, available, not getting ripped off.
Exactly. Your network saves you all that. It provides answers, solutions, support, expertise you don't have yourself.
So it's not just about buying properties. It's about building relationships, which leads perfectly into building your dream team.
That's the core of the network, having the right experts around you.
So who's on this essential team?
Okay, number 1, your realtor, the captain, he calls them. Needs to specialize in investment properties, know the local bylaws, zoning, maybe find off-market deals, negotiate well.
Got it. Then the lender.
Crucial. Someone who understands investment financing can get you multiple mortgages, structure things right.
Good contractor handyman.
Essential for repairs and renovations. Reputable, reliable. Again, not just the cheapest.
A thorough home inspector.
Ideally BCIN certified. They spot the money pits before you buy them. Saves you huge headaches.
Your lawyer.
Handles all the legal stuff, purchase agreements, reviewing those condo status certificates. Crucial for estate planning and wills, too.
Insurance agent.
Often overlooked, but vital. Need the right coverage, like sewer backup insurance. He says an extra $50 a year can save you tens of thousands.
Good point. Property manager.
Definitely for investors who want to be hands-off or for managing trickier stuff like multifamily or student rentals. Keeps things running smoothly. He even jokes about sending them a Christmas gift to stay top of mind.
And lastly, a paralegal.
Useful specifically for handling tenant issues like evictions if you're too busy or uncomfortable dealing with the LTB process yourself.
Wow, that's a comprehensive team. So wrapping this all up, it's been an incredible deep dive. We've really unpacked Mike Desormeaux's approach from Wealth Won't Wait.
Yeah, seeing real estate not just as buying houses, but as a strategic path to financial freedom.
We covered so much. The power of leverage, the numbers compared to stocks, the student debt angle, setting goals, different property types like single family, second suites, student rentals.
The pitfalls to avoid market timing, renovation nightmares, bad tenants, and critically, the importance of that network, that dream team.
It really circles back to that core philosophy he mentioned, doesn't it?
Tough choices, easy life. Easy choices, tough life. It really resonates.
And the idea that in real estate, the turtle wins the race, it's not get rich quick.
Not at all. It's about long-term vision, consistency, patience, letting the strategy work over time.
You hear people say it all the time, that regret. Man, I wish I'd started investing in real estate sooner.
All the time, but his counter is so good. The only other time better than yesterday is today.
To start, even one property held over the long term, the compounding effect, it can be life-changing.
Absolutely. So maybe the final thought for you listening is this. What if that future freedom you're looking for isn't hiding in some shortcut? What if it's built through deliberate, consistent action, building a portfolio, yes, but also building that expert network around you?
What will your story look like in 10 years? What will you have built?